Welcome to this series on the Pandemic Risk Insurance Act of 2020, where we will take a constructive but critical look at H.R. 7011 and other proposals to establish a pandemic insurance program. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. Episode 3, Reward for Concentrating Risk. In the previous episode, we explored how the structure of the federal backstop under the Terrorism Risk Insurance Act, or TRIA, and the proposed Pandemic Risk Insurance Act, or PRIA, penalizes insurers that diversify commercial property and casualty risk. In this episode, we will examine how these same programs reward insurers that concentrate the risk of terrorism loss and pandemic loss, respectively. Let's start with the least efficient use of the backstop, a well-diversified commercial property and casualty insurer. In and among our insurer's $1 billion book of business are 50 policies insuring against business interruption resulting from a pandemic. Based on this $1 billion of total direct earned premium, our 5% PRIA deductible is $50 million. Let's improve that number. First, we exit workers' compensation insurance. Our exposure to pandemic business interruption stays the same, but our deductible drops to $37 million. Commercial liability. That is a big drag on our deductible as well. Let's cancel those policies too. We have now slashed our deductible by nearly 2/3. We can do better. Commercial property insurance includes both property damage and business interruption coverage. Let's make sure our company only writes business interruption insurance. We are now to $90 million of annual premium, giving us a mere $4.5 million deductible. We can still do better. Our business interruption policies cover business interruption from all sorts of perils, like fire, hurricane, and industrial accidents. Let's specialize in pandemic-only business interruption. That would drive our deductible down to $1.25 million. We still have the same 50 policies insuring pandemic business interruption, but we have taken our PRIA deductible down to about 1% of where we were when we started. We don't need to have 50 policyholders. Let's just do business with one. For a $500,000 premium, we have our backstop deductible all the way down to $25,000. Sound silly? Sound impossible? It has happened hundreds of times under the Terrorism Risk Insurance Act. Let's take a look. If a well-diversified commercial property and casualty insurer is the least efficient structure under the backstop, a captive insurance company is by far the most efficient. The Terrorism Risk Insurance Program has a lot of them. As required by Congress, U.S. Treasury collects data from insurers participating in TRIA. It expects about 875 insurers to respond. For the 2018 data call, 575 of those responding insurers were captives. So what are captives? Suppose your main location is in Midtown Manhattan, where you store valuable inventory. You could go to the traditional insurance market for terrorism insurance, say to AIG, Travelers, or Chubb. The challenge is that each of them have TRIA backstop deductibles north of $2 billion, maybe even $2.5 billion. Coverage would be expensive. Besides, nuclear, biological, chemical, and radiological terrorism coverage is really hard to come by in the traditional market. An alternative would be to set up your own insurance company that could directly participate in TRIA. this subsidiary would issue a property insurance policy for its corporate parent and its affiliates. This policy could include terrorism coverage for, let's say, $275 million in inventory, $500 million covering property damage at key locations, plus, of course, business income and extra expense coverage, and $28 million for your namesake diamond. Since we are designing our own policy, we can have it cover nuclear, biological, chemical, and radiological terrorism. All told, that would be about $800 million in limits exposed to the terrorism risk, for which our insurance company would charge its owner $7.5 million per year. Based on 20% of annual direct earned premium, that gives us a terrorism backstop deductible of only $1.5 million. We have now seen how the TRIA and PRIA backstop structures penalize the diversification of risk while rewarding the concentration of risk. In later episodes, we will continue to explore terrorism captives and the companies that use them to directly tap into the federal share. We will continue to look at the elements of PRIA and other proposals for pandemic risk insurance programs in subsequent episodes. In the meantime, you can learn more about the Pandemic Risk Insurance Act and the Terrorism Risk Insurance Act at betterins.org. On behalf of the Centers for Better Insurance, thank you for taking this time.